The accumulation distribution indicator relies on a precise mathematical formula to measure buying and selling pressure. At the heart of the AD indicator is the money flow multiplier. This formula determines if money is flowing into or out of a security based on where it closes within its daily range. The money flow multiplier compares two ranges, from close to low and from high to close. When a stock closes near its high, the result is positive. When it closes near its low, the result is negative. Let's calculate the money flow multiplier for a bullish day. If a stock has a high of 110, a low of 100, and closes at 108. For a bearish day, with the same high and low but a close of only 102, the calculation is significantly different. The next step is to calculate the money flow volume by multiplying the money flow multiplier by the trading volume for that period. Finally, the AD line is calculated by adding today's money flow volume to the previous day's AD value, creating a running total of buying and selling pressure. This chart illustrates how the AD line accumulates over time. When price closes higher in the range, it adds to the AD line. When it closes lower, it subtracts from the line. Let's walk through a concrete example of calculating the AD line over multiple days. To summarize the AD formula, positive money flow multipliers indicate accumulation, negative values indicate distribution, and the AD line tracks this cumulative flow over time. Divergence signals are powerful tools for technical analysts, occurring when the price action disagrees with the accumulation/distribution indicator behavior. Let's first examine bullish divergence. Bullish divergence occurs when price makes a new low, but the accumulation distribution line fails to make a corresponding low. In this example, watch how the price falls to a new low, but the AD line creates a higher low, suggesting accumulation is occurring despite declining prices. Notice these key points. The price creates a lower low, but the AD line makes a higher low. This divergence suggests underlying buying pressure despite falling prices. This bullish divergence suggests accumulation is happening behind the scenes, potentially leading to a trend reversal and price increase. Now let's examine bearish divergence. Bearish divergence occurs when price makes a new high, but the accumulation distribution line fails to confirm this move. In this example, observe how the price climbs to a new high, but the AD line fails to confirm, creating a lower high instead. Here are the critical points. The price reaches a higher high, but the AD line creates a lower high, failing to confirm the price increase. This bearish divergence signals potential distribution occurring behind the scenes, suggesting prices may soon reverse downward despite the current uptrend. Let's summarize the key points about divergence signals. Divergences often signal potential trend reversals. Bullish divergence shows possible buying pressure building, while bearish divergence indicates potential selling pressure despite rising prices. Remember that divergence signals are stronger when they form over longer periods, and they tend to be most effective at market extremes. Let's compare two important volume indicators used in technical analysis: accumulation distribution and on-balance volume. Though both indicators measure volume flow, they calculate and respond to price movements very differently. The accumulation distribution line uses a more nuanced calculation. It considers where the price closes within its daily range. On-balance volume, however, uses a simpler binary approach. It adds the entire volume on up days and subtracts it on down days. To understand their differences, let's observe how both indicators react to the same price movements. The accumulation distribution line considers where price closes within its daily range, making it more sensitive to intraday price action. On-balance volume simply adds or subtracts the entire volume based on whether the close is higher or lower than the previous day. Let's look at a specific scenario that highlights the key difference between these indicators. On-balance volume simply sees a lower close and subtracts the entire volume, giving a bearish signal. The accumulation distribution line, however, recognizes the close is in the upper portion of the day's range, suggesting buying pressure. It adds a portion of the volume, giving a bullish signal. This subtle but important difference makes the accumulation distribution line potentially more accurate in detecting early shifts in market sentiment. The AD indicator can identify potential reversals earlier by capturing nuances in price action that OBV might miss. However, OBV's simplicity makes it excellent for confirming strong trend days, while AD excels at detecting subtle changes in buying and selling pressure. The accumulation distribution line is a powerful tool for identifying potential market reversals before they're confirmed by price action. A flattening AD line during a strong price trend can be an early warning sign of diminishing momentum. Here we see price continuing to rise, but the AD line has flattened, suggesting buying pressure is weakening. Notice how volume decreases as the AD line flattens, even though prices continue rising. This divergence suggests that the uptrend may be running out of steam. An even stronger reversal signal occurs when the AD line begins to move counter to the prevailing price trend. In this bearish example, price continues making higher highs, but the AD line has begun to decline. This indicates distribution is occurring while prices are still rising. Smart money may be selling into strength, often a precursor to a bearish reversal. Note the increased volume, suggesting heavy selling disguised by the rising price. Conversely, when the AD line begins to rise while prices are still falling, it can signal a bullish reversal. Here we see the price in a downtrend, but the AD line has started to climb. This pattern suggests accumulation is occurring despite falling prices. Informed buyers are accumulating positions at lower prices, often before a bullish reversal. The increased volume shows strong buying interest despite the continuing downtrend. Traders should watch for these early warning signs of potential reversals. First, a flattening AD line during a strong price trend, suggesting diminishing momentum. Second, the AD line moving in the opposite direction of price, a powerful signal. Third, increasing volume as the AD line changes direction, confirming the shift. Finally, look for confirmation across multiple timeframes for stronger signals. Remember that AD line reversals often precede actual price reversals, giving traders a valuable edge in anticipating market turning points.